Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Jinchuan Group International Resources Co. Limited Annual Report. Jinchuan Group International Resources Co. Limited is a diversified company that operates in various sectors of the mining industry. At its core, the company engages in mining operations, exploring for copper, cobalt, and copper concentrates. Its extensive portfolio includes several mines across Africa and Asia, such as the Ruashi Mine in the Democratic Republic of Congo, Kinsenda Mine in Haut-Katanga Province, Chibuluma South Mine in Zambia, and the Musinoi and Lubembe projects in the Democratic Republic of Congo. In addition to its mining operations, Jinchuan Group International Resources Co. Limited also trades in minerals and metal products. This indicates that the company is not only involved in extracting raw materials, but also in processing and selling them as finished goods. The company's global presence, with operations in multiple countries including Hong Kong, South Africa, Switzerland, Zambia, China, Singapore, Luxembourg, and South Korea, further underscores its diversified business model. The company's extensive reach and diverse range of activities suggest that it is a significant player in the mining industry. Its ability to operate across different regions and engage in various aspects of the mining value chain makes it a formidable competitor in the market. Jinchuan Group International Resources Co. Limited market capitalization of $8 billion is materially smaller than most of its industry peers of roughly $24 billion. Jinchuan Group International Resources Co. Limited trades at a higher price-to-earnings ratio of 64 times and a higher price-to-book ratio of 1.13 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 47% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a review of the key factors that have impacted the company's financial performance. On the one hand, revenue decline is primarily driven by a decrease in cobalt sales volume and price, as well as a drop in trading division turnover due to selective mineral sourcing. This has resulted in significant losses in cobalt and copper sales. On the other hand, revenue growth can be attributed to an increase in copper revenue due to higher average LME copper prices. Additionally, a decrease in impairment on VAT recoverable has also contributed to revenue growth. These factors highlight the importance of market fluctuations and operational decisions in driving revenue outcomes for the company. The company's debt level and interest expenses have undergone significant changes. Firstly, the current liabilities have seen a substantial increase of 59% from $253,268 to $402,646. Additionally, non-current liabilities have also risen by 16.7%, from $767,346 to $894,022. Furthermore, total bank borrowings and overdrafts have increased by a staggering $105.1 million, from $278.5 million to $383.6 million. In terms of interest expenses, the company has experienced a significant increase. Interest expenses have risen from $30,309 in 2023 to $43,113 in 2024, indicating a substantial rise. Net finance costs have also seen an increase, from $91.67 in 2023 to $12,447 in 2024. These changes suggest that the company is facing higher financial costs, which may impact its overall profitability and sustainability. The company's performance in various segments has been a mixed bag. On the negative side, copper sales and cobalt sales have both seen a decline, with cobalt sales experiencing a significant drop. This is reflected in the trading segment revenue and results, which decreased in 2024 compared to the previous year. However, there are some silver linings. Despite a decrease in metal segment revenue, the metal segment results remained relatively stable. This suggests that while revenue may have taken a hit, the company's overall performance in this area has been more resilient than expected. The company's financial activities have been documented in various reports. One notable aspect is the payment of dividends to its shareholders. In 2024, a dividend of HK 0.2 cents per share was distributed, resulting in a total payout of approximately US $3,206,000. Regarding share buybacks or repurchases, there is no information available in the provided summaries. This suggests that the company has not engaged in any significant share buyback activities during the relevant period. Concerns about inventory buildup and supply chain disruption are valid in the cobalt market. One of the primary concerns is inventory buildup, which is expected to occur due to an oversupply in the cobalt market by 2024. This surplus will put pressure on the intermediate market, as evidenced by the significant increase in the payable ratio for cobalt hydroxide from 57% to 99.5% in 2024. Furthermore, supply chain disruption is also a concern due to the export ban on cobalt raw materials in the Democratic Republic of Congo, DRC. This ban led to a sharp increase in cobalt prices in 2025, highlighting the vulnerability of the global cobalt supply chain. The impact of such disruptions can be far-reaching and have significant consequences for industries that rely heavily on cobalt, including electric vehicle manufacturers and battery producers. That concludes the financial summary for Jinchuan Group International Resources Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.